Joining us this morning, Citi's global head of commodities, Ed Morse, is with us. Ed, it's always good to have you. Thanks for the time. You have had elements of a dovish message on crude for much of the year. Is that changing wholesale?
Well, we actually had a quite bullish view on the summer, and we weren't so far off in arguing Brent was likely to average around $83 a barrel, which is more or less where it has been averaging, although now it's being pulled up a bit higher than that. But yes, we definitely have a view that over time supply is going to outweigh demand growth, and we're going to see it turning up, we think, sooner rather than later. Sooner in the sense that we're on the edge of refinery maintenance season. This is going to be a very deep one, and that means there'll be a lot of oil unsold in the market and start to be seen filling up inventories in a way that we had the summer with the cuts accelerated by Saudi Arabia and Russia, making sure that there was a pull down, an inventory draw. So we're going to see an inventory draw turning in the coming months into what we think is a certain inventory build. Wherever demand is going, on all likelihood.
What kind of on the downside next year? What might we be looking at?
So we're looking at demand growth that's going to be significantly lower than what we think have been forecasted. We think there are a lot of people with us that are arguing that between Europe, China, and the United States, the slowdown or the entry into recession is going to make it clear that global demand growth is going to be in the low 1 million barrel a day plus range, just as GDP growth is likely to be lower next year than this year as a whole. And with that, non-OPEC production alone can more than satisfy the demand growth. So we're looking at prices weakening to below not only 90, but below 80, into the $70 range in 2024, all else equals. And it's going to make it difficult for OPEC to bring oil back to the market. And that's going to probably create a little bit of dispute within the OPEC countries themselves. We have five, what we used to call the Fragile Five countries, members of OPEC: Iran, Iraq, Libya, Nigeria, Venezuela. They're all been seeing higher production rather than lower. We're pretty certain that Iran is going to be up between now and the end of the year. Iraq has a dispute to work out between Baghdad and Ankara, basically, on the reopening of the Kurdish pipeline. We think it's in everybody's interest to see money flowing, whether you're in Kurdistan or Baghdad or in Turkey. And we think sooner or later, and probably by the end of the year, we'll see that 450,000 barrel a day flow going up. And on top of that, Iraq is adding more oil. We see Mexico and Venezuela adding more oil. We see even Nigeria potentially producing 500,000 barrels a day, more on average by the end of the year than they were all of last year and the year before. So we think there's plenty of oil in the market to bring prices down once we get through this hump. And the hump has been created by taking a little bit too much oil out of the market, partly for precautionary reasons, at a time when inventories were unexpectedly very low, particularly for middle distillate. Yeah.
I talked to Secretary Yellen yesterday about this, and she said that they are closely monitoring the price of oil. We've seen this administration take action before when oil prices got too high. What are the options for them, and what's the magic number?
Well, we think we're getting to the magic number, and it depends on whether we hit 100 and how long it stays above it. But, the administration is concerned about heating oil prices in the winter, concerned about gasoline prices. What can they do about it? One of the things they can do about it is focus on where the real shortages are. The biggest shortage is in the East Coast, PADD 1, lack of refining capacity, lack of pipeline capacity to bring in products from the refining centers of the country. And we have this obstacle called the Jones Act, which means that you need an American flag vessel to bring oil from the Gulf Coast to the East Coast. If they suspend that, that would make life potentially easier. They've already indicated that they're going to halt after this round of filling of the SPR is completed, halt further filling of the strategic reserve. But other than freezing exports, which we think they're not going to do, there's not much else they can do to deal with the situation, other than working on getting that Iraqi pipeline up and running and do what they've done so far in encouraging more Iranian oil to come into the market.